Let's talk about investments. So, Chapter 8 is all about investments, and we're going to go into detail about different aspects of investments and kind of what we'll be looking at. This builds upon for the retirement and savings accounts chapter that we're going to be doing in Chapter 9. So, it's important that we learn about stocks, bonds, benefits of mutual funds, and everything in between. So, this is a longer chapter, but there's a lot of important information. So, a stock. When you have a stock, you buy a percentage ownership in a company. So it'd be just like if you're a Green Bay Packers fan, you can buy a share of the ownership. Stocks are the same things. So when you buy it, you don't get to go and make all the decisions in the company. You only represent a portion of that company. Now, where do you go buy stocks? You have to get those on the stock market. Kind of makes sense. So you go to the store, we go to the stock market. There are privately held stocks. This would be for a private company. Stock markets are for public companies. So how do stocks get created? So you have 3 steps. Got a business. I'm doing pretty good. I got some loans. And then all of a sudden I'm going to decide I need to get a little bit more money. So I actually create a new corporation and I say I have this many shares of stocks. So as an owner, I may keep some of them. I may buy portions of those, and I may sell the other ones to generate some capital to invest into my new business ventures. I put them up on an IPO or an initial public offering, and they raise the money. People can buy ownership in that. So what happens is somebody can go, I want 1 stock, or I want 100, 200, 400. It just depends on how interested you are in the business and how well you think it will perform overall. So once you have that initial stock and you make that initial purchase, there's a secondary market. This is where you can buy and sell stocks on a normal basis. So for instance, people that bought Apple back in the day may have had it on an initial public offering. But ever since then, Apple stocks have been trading on a secondary market. When you look at how they are done, you can think of a supply and demand graph. You have a supply side and a demand side. A bid price is going to be the demand side, the highest price a buyer is willing to pay. And an ask price is going to be the supply side of the equation. It's the lowest price somebody's going to be willing to sell a share of their ownership. So if you can imagine 2 crossing lines like you would see on a supply and demand chart, the intersection point is where sales happen, also called the strike point when you're looking at the stock market. So investors buy and sell these through stock exchanges. Owners are entitled by law to a share of the profits in a firm. You can also, if you own a portion of a company, you can vote on who leads that company. So you will see this sometimes depending on the stocks that you own. You may get something in the mail that says, hey, you need to vote on new leadership. Here's the deal. Most of us are never going to own enough shares to fully be able to make a difference in that vote. But people still vote, so there's nothing wrong with it. But you do have to realize that a lot of times there's people who own 48% ownership in a company. So they may have a large number of shares. Each share gives them a percentage of the vote, and they can make that vote known through one choice instead of having everybody else that owns a fractional piece make those decisions. So how does a stockholder make money? Well, there's a few different ways. First one is we can actually have the business make money. So let's go back to the cupcake example. Bill makes a cupcake for $2. It's his gross sell. All the expenses are $1.90. I gotta tell you, he's not making very much on those freaking cupcakes. So he may make 10 cents. And if he sells 10 million cupcakes, he would generate $1 million in profit. So now we know that he has 1 million shares because we saw that on the other chart. When it all comes down, you could actually earning per share in that year. So you take the amount that he earned, 1 million, divide it by the number of shares, 1 million, you're going to get $1 per share owned. Now, how does that work? So there's 2 ways you can make money if you're a shareholder. You can buy and hold and then sell, or you can receive the earnings paid out in something called dividends. So these are the 2 ways you make money with stocks. You buy, that goes up in value, and you sell. Or the company makes money and decides to pay it out to you. Those are your two ways you make money with stocks. So there's different types of stocks out there. Now, you may think, well, there's a bunch of companies, Professor Wilkie. Why are you saying there's different kinds of stocks? Well, when we look at styles, we kind of group stocks together to kind of explain why we look at stocks where they are. So, if you have a growth stock, you think that stock is going to appreciate or get higher value as time goes along. This would be an example of Amazon. It doesn't pay out its earnings. It reinvests those and it continues to grow and become a bigger business. Your hope if you have a growth stock is that you continue to get your value of the stock to rise over time and then you sell at a future date. If you have a stock that pays out a lot of dividends, such as Sunoco or see what other ones do that, Campbell's, you can go through the list and there's a lot of stocks that pay out dividends. If you're getting a large portion of your money back that direction, those would be called income stocks. And there are some stocks that do a little bit of both, and those are called growth and income stocks because you're combining those together. How do you trade and buy stocks? Pretty much you have to have some sort of account that you can store these in. I like to think of it as like a bank account. You store your monies in a bank account. You would store your stocks in a brokerage or a stock account. Now there's a bunch of choices out there. I personally use Edward Jones when I'm doing it because I use a lot for my retirement accounts. But you can use anything from Scottrade, TD Ameritrade, E-Trade, Merrill Lynch. Basically, you have full service brokers and online brokers. Full service are going to do a lot of things for you. Online, you're going to have to do a lot of things for yourself. It depends on how much advice and input you need from professionals. I recommend considering both. Online is going to be cheaper for you in the long run. But sometimes I get phone calls from my Edward Jones person who goes, Chris, we need to do this form, and do this to help you with some tax benefits here. I like having that. I'm willing to pay for it. But that's my decision and mine alone. You need to make your decision as you see fit. Now, there are 3 major stock exchanges in the United States. This is where people can buy and sell stocks. So you can go there. Right now, you can't really go anywhere because of the coronavirus. But when you would want to go trade, you would actually go, hey, would you like this? I'll pay you this amount of money. A lot of this is done digitally, but back in the day, you'd actually have paper shares that needed to be passed around. So your 3 main ones in the United States are New York Stock Exchange, American Stock Exchange, or AMEX, and the NASDAQ. Please note, these are a little different than some of the things you usually watch if you're looking at a ticker tape. These are the names of the stock exchanges. This is a discounted dividend valuation model. We don't need to learn that for this class. PE ratio. This is your price to earnings. So if you took the price of the share of stock and divided by the earnings, you'd get a percentage. This is kind of your percentage return. This is a good way to measure if a stock is going to be valuable for you at the price point it's at. These change all the time, but you tend to see a price to earnings ratio between 10 to 30. And you could do this, but a lot of times websites or investment firms have this number for you so you can get a quick look. Some people use this to guess where the prices are low at or high at so they can try to buy low, sell high. We don't go into that big of detail in this class. Just know that there's a ratio that shows stock prices to earnings, and that's called the PE ratio. So you may see something called small, medium, and large cap funds. This kind of really goes towards mutual funds in the context you will see, but in reality, all stocks kind of fall under one of these. So what this is how much a company is worth if you took the value of a stock or the price of a stock and you multiply it by the number of shares available. So you're going to be a small cap if it's less than 2 billion, mid cap if it's 2 to 10, and large cap if it's over $10 million or $1 billion. This helps you get an idea of what that company's value is. So what's a bond? A bond is a loan to a corporation or a government. Stocks are ownership, bonds are loans. Bond would be considered a debt for most companies. Stocks, that's an ownership interest. So what's the benefits of bonds? You get interest payments, and it's typically lower risk. There's tax incentives for companies to use them, and they help you diversify a portfolio. We're going to talk about diversification in extreme detail. But what you're going to find is that you have to have a balance. So if you are investing, it's March 25th right now, and when you are looking at the stock market, it's been going insane. You've had drops, you've had ups and downs. Bonds are going to be really pretty steady because companies will pay that back on a regular basis, and companies are generating income, so thus they tend to not be so bad. Now, when you look at this, that helps give a more stable approach to your investment portfolio. Stocks tend to swing way faster. So just something to consider. We'll talk more about that in this class. Speaking of it, asset allocation is how you have your assets invested. So you have $1,000. How you invest that $1,000 would be your asset allocation. Never put all of your eggs in one basket. That's the definition of diversification. Spread your investments across different types of assets to manage financial risk. If you do that, some may fail, some may drop, some may be outstanding, some may be the best stock you've ever bought. But when you average those out, you don't tend to have the humongous swings. They tend to offset each other, and you tend to move in a general direction instead of just down or up. If you were looking at what you may be doing as a college student who's taking Finance 101, for your first 15 years of life, you may be in a diversification like this. You may have 85% stocks, 10% bonds, 5% cash. If you actually look at my portfolios, this is pretty much what I have. As you get older, you tend to go a little more conservative or a little bit safer with your money. But all in all, you are going to see that the more you invest in stocks, the greater the risk, but the greater the return on the same end of that. So when you look at this kind of compares a bond to a stock. Dividends are never guaranteed. It depends on the performance of the company. Predetermined interest would be. So a bond is going to have a steadier stream of income, but you're not going to get an appreciation of a bond or a value up there. If a company does really well, you're still only going to get the amount that was agreed to in the contractual agreement. If they do poorly, you always have the risk of default or not paying on the loan, but most of the time these businesses do pay that. Now, there's some features of a bond that kind of make this slightly confusing, but in all honesty, bonds are pretty straightforward. You have the face value. This is the amount that was borrowed. Maturity date is when the loan has to be paid off by. The coupon rate is the interest rate on the loan that you lent to the company. And the coupon payment will be that what you end up making or they end up paying in interest when it's all said and done. Kind of like a student loan. Kind of like a credit card loan, car loan. But that's what these bonds are. They're just essentially a loan for a company, and you can help lend that money to a company. Here's where you can see where bonds exist. You have corporate mortgage, treasury, state, local government, and other. And when we look at corporate and federal bonds, corporate bonds tend to provide a higher interest rate and a longer maturity date. Federal government bonds are similar to U.S. savings bonds, but they have a little bit of differences. They have different time frames they can have a maturity date on. Sometimes you have a year or less, 1 to 10 years, or 10 to 30 years. I would note what these are all called. They go bills, notes, bonds. When you look at state and local government, they do issue municipal bonds. Sometimes these are to help with infrastructure. And if you do this, you are tax exempt from the interest that you earn at a federal level. Ball State, for instance, took out bonds for some of their new residence hall facilities and some of their renovations. There's a bond issuance there. And then you look at other parts of Indiana in itself, lots of bonds are issued to help governments create projects or do things, and then you can invest in those and get interest-free growth over time. Now, when we look at a bond, we have to assume that most people are going to pay them back. But just like we have a credit score and a credit report, corporations have what's called default risk, and there's rating agencies that look at this. So on our end, credit report is by the 3 major credit bureaus, Experian, TransUnion, and Equifax. Now, when you're comparing this, the bond market has two that are well known: Standard & Poor's and Moody's. So these are going to look at companies instead of individuals to see how trustworthy they are in order to make that loan and how likely they are to make that payment back. So now when we look at companies, they have ratings about their credit worthiness. And what you're looking at is you basically have AAA is the highest, or the all capital AAA. Then you have the lowest is going to be D or C. So you're looking for the higher number of A's, and the better that rating is, the more likely they are going to be able to pay that bond back to you. I'm going to skip a few of these, but key thing to note about this: if the current interest rate is less than the coupon rate, then the fair market value is greater than the face value. There's an inverse relationship that happens here. This is something to note: as interest rates drop or rise, that bond interest rates and coupon rates change as well. I'm going to skip that. We have a very large lecture here, so we're going to try to get through as much as we can. Mutual funds. Mutual funds are essentially a way an individual can invest in multiple different assets by only investing in one asset. So the best way to describe this is like one of those gift baskets. You get a little bit of this, a little bit of that, a little bit of this, and by doing that, you are diversifying your money, but not having to go out and buy one share of this, one share of that, one share of this. Mutual funds pull the money together of individual investors and make large purchases to invest on behalf of those investors. So there's two kinds of risk that you're going to, two, and then they add up to a third. You have systematic risk. We cannot eliminate this whatsoever. But if we do diversify, we do eliminate unsystematic risk. When you add those two together, you get your total risk of your investment. Two kind of funds that we look at: passively and actively managed funds. Passively, they select a thing of stocks, it buys that, and we just see what happens. These are a lot cheaper, and they tend to mirror the stock market. Actively managed funds, they tend to cost more, and what they do is they have somebody or a group of individuals who are actively buying and selling stocks in order to try to beat the market. When compared on the long term, they perform about the same, but actively managed funds do have higher fees, so most people tell you to go with a passively managed fund route. So this gives you an example. It's about a percentage higher on the passively managed, and that has to do with the stock market and the cost. Try to keep your fees to a minimum. So a sales load fee is a one-time commission paid to an investment salesperson when the mutual fund is purchased or sold. You want to look for no load fees. Try not to pay a 12B-1 fee. That's a marketing expense that is passed from the mutual fund to the shareholders. Eliminate fees if possible. The lower the fees, the better off you're going to be. Look for the lowest expense ratio. You will get to see these when you make stock investments. Look for the lower the number. So you're looking for something that's 0.0 or 0.2 or lower is what you want to look at. Don't go any higher than that, because the lower your expenses, the higher your returns will be. One thing I do want to mention, asset allocation funds, they predetermine the asset allocation. That's pretty much what we showed a few slides ago with the pie graph, but they do this based upon a formula they create. Target date funds are a little bit interesting, and if you have no other idea what to invest in during your time as an adult, pick the target fund that matches your ability. Pick the most risky now, and what it'll do is it'll slowly shift over time from stocks, heavy on stocks, to heavy on bonds as you go through. Basically, you pick the target date of your retirement, and that fund will shift for you. So if you have nothing else that you want to or know how to pick, and you just want to pick the easiest base route, pick the target date fund with the farthest date off in the future. Right now, I believe that's 2060 or 2065, but choose that because it'll do the heavy lifting for you if you don't want to make educated decisions on your own. That's my piece of advice for you today. See how it shifts? It goes stocks heavy, and then it shifts to bonds as you get a little bit older. ETFs. These are essentially mutual funds, but they are mutual funds that are a little different. So mutual funds, you tend to buy into those, and then you have to wait a little bit before you can buy out or sell out. An ETF, you can share these back and forth and buy and sell quickly. You can do them on throughout the trading day. Mutual funds, you can buy them once per day. These are index-based securities, and they tend to have lower fees than mutual funds. What you find is that a lot of people are starting to buy ETFs compared to mutual funds overall. The lower fees are the main reason people do this. It's all up to you, but if you're looking for some advice, go the ETF route. The ETF is going to be cheaper. The cheaper you have, the more money you will keep in your account, the more that it can grow over time. So this is their comparison. You can actually look between the two of them. Not a ton of difference, but you see that some people would consider ETFs a little bit better. Okay, so you can invest locally or abroad. A few terms to know: GDP, or gross domestic product, is how an economy is growing. So you'll hear that referenced a lot, but that's what that means. You can also see that the different countries grow at different rates. This is a long economics discussion about how countries and economies grow, but just something to look at. Something else is interesting. The GDP is $18.56 million. As of yesterday, they were looking at a $2 trillion push through infusion of cash through a stimulus plan. So you can see that would be almost 10% of our GDP, which would be a pretty large amount. So, why foreign investments? Well, not all great companies are from the U.S. There are companies that are good that are from other places out there. It can also help with diversification. If the U.S. economy is struggling and others are not, maybe it'd be a pretty good thing to invest in both. You also use a lot of foreign products. When you use these foreign products, you're actually helping those businesses grow. And since you're helping them grow, you may want to invest in them because you obviously know that you like those products. There's some mathematical reasons as well. There's low correlation. So if a stock goes up in China, it may not go down. U.S. stocks may not go down. So there's this kind of, it spreads out diversification-wise based upon math. Some risk: you can have higher exchange rates, market operations, trading costs, regulatory oversight, or country risk. Anytime you invest, you're going to have some sort of risk. Don't over invest in foreign funds, but use them as a source of diversification. Pick how you want to invest and invest that way. As long as you know the facts and the risks that are involved, you can make educated decisions about your financial future. How do you buy these funds? You can buy them through the ADR, or American Depository Receipts. More commonly, you buy them in a mutual fund or an ETF. That's how most Americans are going to be buying funds abroad. So there's different kinds of international investments. You can have global funds, which just are all foreign companies. International funds that do outside of the U.S. only. Regional is going to be in a specific area. And countries are going to be over a specific country, such as China. First rule of risk: greater the risk, the higher the return. Kind of makes sense. Financial risk increases as liquidity risk increases. Remember, liquidity is how quickly you can turn something into cash. When you can't turn it into cash very quickly, the risk goes up. The ability to sell something, or the marketability of how you can be sold, the greater that is, of not finding a big audience to sell it to, the greater the risk, but in turn, the greater the possible reward. If you want to have higher returns, you need to be able to take more financial risk, sacrifice some liquidity, and give up some of that marketability. You have a risk tolerance. When you do this, you have an ability to either take risk or you're a little bit risk adverse. You could take tests online to show where you're at, but most people in the age of 20 to 30 should be pretty risk happy with their investments because they have a long time before they're going to be needing to pull from those. It's like right now the stock market's in total chaos. If I was retiring, I'd be a little worried. As my age that I am, not so worried. I got plenty of time. I hope it rebounds over that time, and I will see if that money comes back over that time. So when you build your portfolio, it matches your risk tolerance, and you try to diversify at the same time. So this one looks like someone would be the age of 40 to 50 because they have a good heavy amount of bonds at that 30% mark. If you were a little younger and a little riskier, you'd be between the 10 and 20% mark. But you can see it has 60% stocks, 30% bonds, and 10% cash. So it's risky, but it's not the riskiest that you could have. Volatility is like a roller coaster. If you were looking today, this would be what we've seen in the last week in the stock market. Sometimes this happens over years. Volatility measures the ups and downs, the changes. Inflation is the measure of how prices paid by consumers and goods change over time. Sometimes it occurs slowly, sometimes it takes a long time, and sometimes deflation happens when the prices go down. The CPI, or the Consumer Price Index, helps you measure if the inflation is occurring. We've already talked about brokerage accounts. We have full-service brokers and online discount brokers. This is going to give you an idea of some of the steps you may have to take. I don't see the full service as that bad with the initial deposit. I use Edward Jones. My initial deposit was $1,000. I tend to like what I have there. I've had self-directed accounts before, but it's all up to you. There's different types of orders that you can place when you are buying stocks. Most people are going to use a market order. This is going to buy what it is at a certain point in time. Limit orders tell when you can only buy at a certain price point or better. And stop orders happen when you tell only if a stock's you can only buy if it falls below a certain set point or sell at that point in time. Most of you will always use market orders unless you're trading on your own. Then you may be using limit or stop orders. Now, investing in real estate. There are two different kinds of real estate you can invest in, residential or commercial. These are use assets. So more that you use it, the less it's worth, unless you put in additional capital to keep it up to par. So if you drive a car around, you're going to wear that car out unless you keep the car up to date. Real estate's viewed as a investment asset because it is a use asset, but most of the time, over time, it does appreciate in value, so you can sell it for more than it's worth as long as you keep it in its current state or in a better state. Most people will invest in real estate through what is called a real estate investment trust, or an REIT. This helps you not have to go out and buy a freaking house. So you can just go out and buy a share into the REIT. It will they will buy property, manage property, and then send out money to you based upon a percentage of what is made. So these are like mutual funds, but for real estate. Other ways you can invest: you could buy collectibles, auctions, and other techniques. We don't need to talk about these in detail. If you're really interested in this, you will find that you will learn this on your own and grow, and you may become a great collector. Don't do Beanie Babies. They talk about teddy bears on here, but it just depends on what you're looking for. You can see kind of the timeline of these people, how the transaction happens. We talk about supply and demand for a little bit. You look at the global stamp market is very small compared to the stock market. And how do you protect your investments? So always, if it's too good to be true, don't believe it. Always get things in writing and never worry about word of mouth referrals. Always triple check your information and watch your own money. Talks about hedge funds shortly. Also with a financial advisor. Most of the stuff we've already talked about or you've had an assignment over. So that should be the end of this chapter. And I hope that you guys have learned a few things about investments. And if you have any questions, please let me know on Canvas or via email, and I'll be happy to assist.